over here as well. Okay, so welcome everybody to our live session for this evening. Appreciate people showing up. A few things we're going to talk about. We just started Q2, so obviously we want to talk about the market overall and ideas about where I think things are going from here. Um, there's obviously with everything going on with well, I mean, 2 years ago, everything is about whatever the Federal Reserve is doing is really driving the market. And obviously, over the last 6 months, it's really been everything that the president has been doing. And um, like the guy or not, he has definitely had a incredible impact on how the market moves. And so we've definitely got to speak about that. Um, the the other two things that I want to talk about, one of them is a thing that came up recently, and I've really put more effort into, and it's probably something that people need to be much more aware of, is talking about some of the tax implications to trading the market. So I want to go over a couple of things. Oh, excuse me, a couple of things that you can do to really, hopefully, save yourself a lot of money. So we'll talk about a few of those things, and then the last one is this new concept that I've been working on. Um, a lot of the stuff that we do day to day is a lot of day trading stuff. We have several people in the group that are day traders. That's pretty much all they do all day. Some people do it for a living. Some people just have, I don't know, a lot of extra time in their day. And so we're not always too focused on the longer term stuff. I know that Steve does some leap trades and stuff. Um, but there's a few things around that that I have wanted to talk about as well. Personally, I don't want to keep day trading for the rest of my life. It is, even when you're regularly successful at it, it's very stressful. And I don't think that's the way I want to keep going with my trading. And so I've been looking at alternate ways to sort of transition to a little more long term, not necessarily just long term investing, but you know, migrating over to taking more swings, holds over not just a couple of days, but swings that I can hold for a couple of weeks or a couple of months, stuff like that. And so that has a lot of impact on that as well. So we're gonna talk about that. And then the last thing is, if you guys have any stocks and stuff that you want me to take a look at, I'll say hold on to them just for now, but a little bit later, if you want to start just throwing them into the chat, just that I don't have to kind of scroll back too far. Um, and then I'll also go over those and kind of give a review of what I see happening on the big picture for any stocks that you want me to look at as well. Obviously, if you guys have any questions, just throw them up in the chat as well. I'll refer back to that from time to time just to answer any question you guys throw in, and I'll try to keep them timely to whatever we're discussing, so I won't let them go for too long before I answer those questions. Okay, so let's start off looking at the market overall. Um, so just sort of a recap for the year, things started off sort of bullish. Things were pushing up, hadn't quite hit new all-time highs in the market itself, but a lot of other stuff. Um, Several other tickers, several other stocks had, and then of course we got hit with the discussions about tariffs and how everything that was going on there, and that was during the election, if you recall, that was not something that was really talked about, and so I think it caught a lot of people off guard, and certainly even people uh, even people from the conservative side had some real questions about it. And um, well, let's just say there was a very strong impact, and the market as a whole dropped a whole bunch, and it continued going down as these comments seemed to be just wildly thrown out there. And there was a lot of speculation about, whether the White House knew what they were doing or not. And I don't want to get into the politics of it. I'm just sort of recapping the impact of what was impacting the market and why. And so there was a lot of unknowns, and that's really what it comes down to. And the market hates unknowns, absolutely abhors them. And so that was driving everything to the downside. Um, and probably the really big turning point, um, everything came down to negotiation of new trade deals with their trading partners. And when the UK, and this is something that I had actually mentioned several times as we in my weekly discussions with the ACNI group, and I talked about this seemed like maybe it was maybe it was Trump coming in to the negotiating table, like the equivalent of walking into a negotiating table, slamming your fist on the table to get everyone's attention and say, "Hey, look, I'm serious. We need to get something done here." Um, and so when he initiated that first trade deal that they completed with the UK, that kind of sent the signal because he came back and said, "Oh yeah, all the stuff that we were doing, the big tariffs and the heavy hitting and stuff. No, we negotiated a very great trade deal with the UK, and so uh, they're really not going to have a huge impact from these tariffs." And that kind of really set the ball rolling for everyone else to say, "Oh, okay, this is what's going on. We just need to really get our trade deal negotiated and get it done quickly so that we don't get impacted by all this." And that's what we've seen. And every time another trade deal is announced or progress on a trade deal, we've heard about progress, although I guess it went a little back and forth, progress with China. They've talked for a couple of weeks now about almost being complete with the deal with India. And so the more these trade deals get completed, the more the happier, the less unknowns there are, and so the better the market's been doing. And originally, I was saying that I had the expectation that they would get the trade deals done, and initially I said end of Q2. And that by the end of the year, we wouldn't even care. The market will recovered enough that we weren't even worried about what had happened at the front of the year. Now, realizing now the number of trade deals that need to be negotiated, it's obviously going to take much longer, but a lot of the big priority ones seem to be front loaded. And so even though the trade deals aren't completed, we've obviously recovered. We've made new all-time highs this week. And so, um, you know, the to kind of give it all away in the beginning, I still feel that the market is going to be doing very, very well by the end of the year. Uh, they do have to continue these negotiations. And obviously, there are other things going on. There are geopolitical events that definitely could spark things up and cause more grief for the market. Um, but we don't know for sure any of that stuff is going to happen. Um, a lot of that stuff seems to also be negotiating reasonably well. And so we can't rely on that. We've got to go with the data that we currently have. And right now, everything looks like it should continue moving. Will there be more pullbacks in the market similar to what we've seen, not to the big scale that we saw through March and April, but here in May we had a pullback. We had one in early, well, let's say mid-June, a little bit of pullback. So that sort of thing I think will continue. Could we see even some bigger ones than that? Possibly. But we're definitely trending back to the upside. And my expectation is that's going to continue. Um, I think the next big things that are going to impact us are so when all this stuff was announced, all the talk about the tariffs and stuff, a lot of companies that depend on resources and maybe finding some of those resources that they were getting from other countries was going to be very difficult for them. So a lot of those companies actually went out and uh, pre-bought a whole lot of whether it was items that they resell or it was materials that they need to make their products, whatever it was, a lot of companies went out and bought that stuff early, spent the money up front so that they could avoid the tariffs. So, according to the Federal Reserve, we're at a point now where a lot of people have been kind of able to avoid some of those tariffs because of that. But now, as they get to the point where they're reordering, they've run out of materials, they've got to go back. The Federal Reserve says that we'll start seeing the real impact of the tariffs as we go into this. And of course, there was this July 9th date where where a lot of these tariffs should be reapplied. We don't know whether that's actually going to happen or not. It may end up getting pushed back again. Of course, anytime you got to think about the negotiations that are going on. When people go back to the president and say, "Hey, how are things going? Do you think you'll end up postponing those tariffs even further beyond the July 9th date?" He can't turn around and say, "Yeah, you know what? Don't worry about it. If we need to, we'll push them back." That completely kills his leverage for negotiation. So he has to come out and say, "No, we're not changing that date. If we don't get things done, those tariffs are going in." And even when things don't go well, we've seen how much he throws new stuff in. He's talked about how he's going to uh, go harder with tariffs on Japan. He talked about it when Canada talked about the digital services tax. He turned around and said, "No, we're stopping negotiations on Monday. I'm going to tell them what their new tariffs rate are." So he has no problem throwing that threat around, because it's keeping some leverage. The reality is that the whole reason he's in any position to have these discussions in the first place is that the U.S. does have uh, over $1 trillion in trade deficit. Uh, they, uh, the U.S. is pretty much every other country's biggest customer. Um, so yeah, the when we get into this, if those tariffs end up going into place, it's just going to, they'll actually start getting paid at this point. There won't be any surplus materials to avoid some of them. And so we'll see what the real impact of that is going to be. Prices will definitely go up, maybe not for everything. We've already seen it with Walmart. They said that we can't hold back anymore. We've got to start putting them in place. Um, in fact, um, the, well, excuse me. Basically, the question was, could they eat that extra cost and not pass it on to the end user? And I'm obviously the margins for every business are different, but Walmart's not in a position where they can take that sort of hit and still be able to make any sort of profit. They would be losing money. Um, and that's just the nature of that business. So that's what we really need to see. That will be the thing that tests what's going on, because obviously um, when it comes to consumer staples, those are the things that people are still going to need to buy. And if the price of that goes up, that means they've got less money for all those other sectors. I guess the same thing goes for things like utilities, energy to a degree. People need to keep their homes heated. They need to keep food on the table. They need to keep gas in their car. But that could mean that people are going out to restaurants less, that they're spending less on home decor kind of stuff. So we'll have to see what the bigger impact is. And that's why I say that we could see some pullbacks in the market. But again, even if those tariffs do go into place, as we start to see more trade deals get completed, then those will start to dissipate. And that's the same thing the Federal Reserve has said. They expect that um, they've been saying that companies are kind of reserved right now. They're kind of holding back until they see what the end trade policies. Once the trade policies settle, then they believe everybody will be back to business as normal. We obviously still have inflation problems to deal with and stuff, and that's not going to go away anytime soon. Um, but I think it'll be manageable, at least a little more manageable than it is currently. Um, they've also talked about rate reductions, which will help businesses. Whether or not it's good for the economy or not, uh, I guess that's for someone else to talk about. But from a business and the stock related to those businesses, having those rates cut would be a good thing. It's always good for a business for their stock and for their future plans when it's easier for them to borrow money. Um, yeah. So as far as setting levels and stuff, I couldn't really say, but what I will be watching is the trend of things and how they're moving. There probably won't be, during the pullbacks, there won't be a whole lot of stocks that I would be looking to short. This is all big picture stuff that I'm talking about. And so with that, I would wait through those pullbacks and you basically use those as opportunities to get into stuff long term. Um, I have been tracking my own um, long term investment stuff as well. And my plan was to get back into stuff, a lot of stuff this year. I had been, since 2022, I had been mostly in precious metals. And my plan had always been the start of January of 2024 that I would, all to do with a lot of stuff that was going on with the Federal Reserve. But my plan was to get out of the precious metals and rebalance my portfolio into securities. Now, at that point, there was all this stuff. We already knew that Donald Trump was going to be running for president again. There were a lot of unknowns again around that stuff. So I decided that I would wait until the election. And so I didn't end up selling out of the precious metal stuff that I had until literally just before the election. Probably would have done well to hold past the election a little bit. But anyway, that's where I made the change, went to all cash. And I started before we knew about the tariffs. I had started getting into a few things and then I held off. And then since then, some of these things I've been getting back into. And so as I go through my big picture list, my big picture watch list, all I'm doing is I'm waiting for them to either ones that haven't started their moves back up, haven't given signals on the big picture to get into them. I'm still waiting for those to start. There are other ones that have made some pretty healthy moves, and I'm waiting to see if they will pull back before I get an opportunity to get into those. Um, Here, I can very quickly kind of give you an idea of what I'm talking about. So here is this is the list of everything that I'm looking at buying stocks for. So as an example, here's Apple that started giving me signals that I was looking for to go long just recently. And so I bought shares at 201 for that. Um, I'm just trying to find a couple that I can give you some ideas. So the entry point that I haven't touched yet for Amazon, but it started giving signals in the end of April. Uh, Delta Airlines actually started giving signals. That was also, yeah, very beginning of May. So all within those areas, we started getting those, starting to tell me to get in. Like I said, there were some that I have selected now. Um, as a long-term investment, I mean stuff that I'm going to hold for like 5, 10 years at least. Then the plan was never to just say, okay, let's just buy them all at once and get in. It was get in a little bit at a time, do it in several several tranches of stock at a time, and not to do it all at once. Almost a kind of a simplified dollar cost averaging in chunks throughout the year. So that's the plan. And so I'm just waiting for more of those to give those signals as we continue up. Okay, so um, that's basically what I'm looking for from this aspect. I see you guys are putting a lot of tickers in there, so good. We will get to those, but let me shift gears now. And since we're talking about buying these things, let's have this discussion that I wanted to have about taxes. So obviously, anytime that you are trading, then uh, you've got to look at things around the capital gains that you're going to pay for things, short-term versus long-term gains, and those sort of things. And the first thing I will tell you, I am not an accountant. I'm not a financial advisor. So everything that I'm going to tell you here is my own personal knowledge, and I would really suggest that based on that, you take that opportunity to now discuss this with your accountant or tax lawyer or financial advisor or whoever it is that you're using to discuss those things. Have that conversation with them. Make sure that you've got the correct version of what I'm telling you based on your location, the country you live in, the state that you live in, um, and that it fits the profile for your tax returns and the way you do things. Um, okay, so The very, very basic idea to all this is that when you take gains in the stock market, that you have to pay taxes on those gains. And there's a few different ways that this happens. Um, you've got probably the biggest difference is your short-term gains versus long-term gains, where short-term gains are essentially taxed as if they're income, and long-term gains are taxed at a separate, generally lower tax rate. The difference between the two is that a long-term capital gain is anything that you've held for over a year. So if you held it for 11 months, you're going to pay short term. If you hold it for 12 months and a day, you're going to pay long term capital gains. Um, Now, the one exception to that would be if you are trading in a tax sheltered account. So these would be so in Canada we have there's actually a tax free savings account and an RSP, which are those two vehicles. You've got I actually don't know if the 401k ends up being tax sheltered, but you've got the equivalents in the US. Um, and in a tax sheltered account, like a Roth IRA, those sort of things, the tax sheltered accounts, the good thing about those is that um, it waits until you actually sell, and it just looks at the straight gains that were made, or also losses taken if you took losses instead. But that's all calculated only um, only on the total for the year, basically. It's a little bit different if you're using other types of accounts that aren't tax sheltered because they take calculations against every sale that's made. And so let's just look at it from a very basic example where you bought two stocks. You bought Apple and you bought UNH. You bought them in December of 2020. Let's say we'll make it a year. I won't even give you dates or anything, but let's say you, excuse me, you buy both of those stocks, you hold them for a little over a year, and now you sell them both. And let's say you made $20,000 on the Apple, but you lost $10,000 on UNH, and then the net sum ends up being $10,000, and so you pay long-term capital gains on that $10,000. That's the very, very simplified way of looking at it. And that's essentially true. That's what happens. Um, and then, of course, if you sold it in under a year, then you pay the short-term capital gains. Same thing. But there is another thing that you have to look at within that that's very important, and it's less important for people that are doing long-term stuff. Unbelievably important for people that are doing short-term stuff like day trading, because you have what's called a wash rule, and the wash rule simply says anytime you sell a security, if you sell it for a loss, any trade, any purchase that you make, um, any other purchase that make or gains that you make, so after you sell, if you buy that particular stock or derivative of that stock, like options, if you buy it again within 30 days of selling it, you can no longer claim that loss on your taxes. And that's called the wash rule. And what they're doing is they were trying to avoid people who were in a position where they had a hefty loss at the end of the year, and they were just going to artificially take those losses, claim them at the end of the year so that they could use them on their taxes. And then on January 2nd, they were just going to go out and rebuy those stocks so that they could, get the gains back again while taking advantage of claiming those losses. Um, and so it was kind of a little like tax avoidance thing that the government, it was a loophole that they wanted to seal. And, they were right to do so for the big picture, but for the people that are not, that's not the way they're trading, people that are doing short-term trading, day trading and stuff, then it becomes an issue for them because it traps them with with needing to claim to pay taxes on money that they didn't really make. So let me give you an example of what we're talking about, and I'll use averages, and we're just talking day trader people. But remember, even if you're just doing swings, if you're taking swings in a particular stock and you take a loss and then you want to re-enter that swing within 30 days, you still have to worry about that wash rule. But let's do something very, very basic. And let's say um, you're day trading, and I'm going to talk averages here. So you're day trading every day, and let's say you're using $1,000. That's the amount of money that you put into every trade that you take. Um, and so you go through a day, and let's say on average that you made 30% profit every day that you took a trade. And I'm just pulling these numbers out of the thin air just to use some easy numbers that make the math simple to look at. So you take 30% profit in the gains, but at the same time, you ended up taking about 10% in losses. And that happens on a daily basis. So every day you're gaining about $300, you're losing $100. So your net take is $200 a day. You do that 252 times, that's 252 trading days in a year. And over the year, let's say your total gains were about $75,000. The losses that you took were about $25,000. So of that, if you were making that amount of money very roughly, and I took this number and I based it very roughly off of someone that makes about $75,000 a year and lives in Michigan. I just picked that. It was easy. It was a place that I could find that was close by. And I could tell you that very roughly, the tax rate that someone pays in that case would be about 15.22%. So here's where the problem comes in. Your total profit was $50,000. And normally, if you made $50,000, the taxes that you would pay at that tax rate would be about $7,670. But because of the wash rule, and because let's say you're trading SPY every day in and out like I do, these losses, you can't claim any of them. So you're actually paying taxes on the full 75,600. So the real amount that you're paying taxes on, or the real amount of taxes that you end up paying, are a little over $11,000. That's 50% higher, roughly, than this number. And that's significant. I have for years, for various reasons, and honestly, I was there was also some laziness involved. I could tell you right now, I have been overpaying a lot because I had been doing a lot of just this. And my reasoning at the time was that because I trade SPY options, I like to be more granular with my ability to take entries and take exits. And so I wanted to buy a handful of options at a time so that I could get into the trade. And then when I was getting out, I could take some partial profit here and some partial profit there and, get out of it slowly if things were moving and doing well for me. At the same time, if there were, in some occasions, there were areas where I may want to average down. So I may want to add some, not like the full amount that I was trading, but maybe a bit to average down to make, maybe it was moving against me a bit and it would make recovering a little bit easier. And so if I wanted to use something else, something bigger, it would be very difficult to do that. So that was generally my reasoning behind continuing to use SPY, knowing that I was paying a lot of extra taxes on this stuff. But recently, I've really started to look into it and doing taxes, especially this year. I kind of looked at it and said, you know what, I'm really spending a lot of extra money in taxes that I need to find a better way of doing this. So there are cases of for people that are day trading, there are vehicles that you could use that are not subject to wash rules, and they're basically mostly indexes and derivatives of those indexes. So if you're trading SPX instead of SPY or XPX options, And then there are a few other derivatives within, like I'm using SPX as the example. You've also got XSP, which is a smaller version, although there's not a lot of liquidity in XSP. So you can use something like that, which doesn't have wash rules. And then there's also there's also futures. And I know not a lot of people at OP talk about trading futures. I know there are some people that are doing it. Um, there's definitely a whole other learning curve to to trading futures and understanding that. But it is, trading E-mini, which is like um, the mini SPX futures, is something a little more comparable to what we're doing with options. So there's some opportunities there as well. All of those are exempt from the wash rule. There's a form 1256 if you're in the US. That's what applies to them. And on top of that, there is also something called the 60/40 rule. So we talked about long-term gains and short-term gains being whether or not you hold something for a year. Well, SPX and all those derivatives around it, including futures and stuff, they have instead of looking at whether how long you held them, in all cases, 60% of what you make on those get the, oh, you know what? I even did this math wrong. Sorry, I'm confusing myself. That I need to put this in here just to change this. The actual tax rate that I meant to put in here was 18.86. It doesn't change anything when I talked about this being 50% larger than this or any of that stuff, but that's important for what I'm about to tell you. So 60% of the revenue, the gains that you make from the sale of your XPX options, they're going to get taxed at the long-term tax rate. Despite even if you only held them for a day or part of a day, 60% of that gets taxed at long-term um, capital gains, and then the other 40% gets charged the small cap um, percentage, which is basically income, whatever income tax rates you're in for those. So it's the long-term capital gains. In this case, the very quick math that I worked out was about 15.22. And so where normally, without the wash rule alone, you would be paying $9,500 in taxes, which be the tax against your total profit, the gains minus the losses. And then on top of that, because of the long-term taxes, that actually gets reduced by about another $1,100. So this ends up being the rate that you paid for the taxes on this amount, total profit, not against that. And so obviously this is significantly lower than this amount. Um, so yeah, I have, despite the fact that it's been, um, like I said, I like to trade with a more granular amount of contracts, but I've started moving over to using SPX instead, just for this very reason. Um, Also, these tax numbers and stuff, these are just examples, so they're obviously not exactly right. Like I said before, talk to your own tax people, work it out with them. If you are day trading and trading that regularly, it's not like you're going to be able to every day for 30 days find a different ticker to trade. And of course, you would only be able to do one trade a day. Um, I guess the exception would be if you do nothing but win, then hey, you don't have to worry about that. But uh, that's not happening to any of us. So yeah, you have to find something like this if you want to avoid paying all those taxes. If you're taking swings that you are like you're taking occasional swings, and you're moving around between different tickers, so you're not trading the same one all the time, and you literally only take once you traded a stock, you avoid it for another month. You could do it that way as well. It's going to get very difficult to start finding opportunities like that. But excuse me. But on the other hand, it may also be worth it in some cases just to say, hey, you know what? I'm going to my losses are kept. minimal. So I'm okay to eat the extra taxes in some cases on those swings. That's a possibility. Um, and then of course for long-term investing, then it's you're something that you're going to be holding for years. You probably don't have to worry about anyway. Um, yeah. So if you guys have any questions about that, like I said, I'm not an accountant. I can't answer big questions, but if you have some simple questions around that, I'm happy to answer that stuff. And while you're thinking about that, I will talk about the third thing that I want to talk about, and then we can move on to looking at the stocks that you guys have posted. Okay, so back over to the charts. All right. So as we come to the end of Q2, as we just did, and we're in Q3 right now, um, a couple of things usually come up. We start talking about big institutions rebalancing their portfolios, changing things around, getting stuff back to uh, the state that they want their portfolio to look like. I mean, you end up with this portfolio where maybe you've got a section of stocks that are supposed to be your medium runners, and then you've got your high volatility stocks, and all those take up a portion of your portfolio. And all of a sudden, your risky stocks that are a small portion of your portfolio, they do really really well in one quarter, and so they run up, and as a percentage, they end up becoming a much bigger percentage than it's supposed to be within your portfolio. So, as a big institution, like if you're running some sort of um, mutual fund or something, then you end up collapsing that. You end up selling off a bunch of those and redistributing, rebalancing that money across the other portions so that you can get back to those percentages that you normally have. Like, maybe they keep only 10% of the stock is in risky stuff. So they've got to reduce that money down so that it's back to 10% of the overall fund. So I was looking at that sort of stuff. And the other thing that always gets talked about with that is things like sector rotations. And so I think about sector rotations from time to time. I have a watch list that I even keep called my sector list, which is let me just make this a little bit easier to and some extra data. So this is basically a list, and airlines is not a sector, but I like to keep that. Automotive is not a sector, but I like to break them up separately. But the idea is that essentially those are separate little components of different stocks within the different sectors, and it's usually the heaviest weighted or the highest market cap stocks for each one of those sectors. And I watch this on a regular basis to get an idea of when the market's moving and how it's moving, how are each of these sectors being impacted? And so from that, I can get a little bit of an idea of what sectors are doing better than others, but it's just based on a handful of stocks. It's not a good, strong indication of sector rotations. And so I wanted to see if there was maybe a better way of making that determination. So I've been doing some research around it. And remember, this goes back to the stuff I was talking about wanting to eventually transition into doing more longer term swings, less day trading. And so the idea is if we can recognize when sector rotations are happening, then we can start focusing on taking bigger swings in some either the ETF for that sector or the individual stocks that make up that sector. So, as an example, if we see a rotation into tech stocks, which is very often, um, when we see that rotation into tech stocks, then we could look at some of the big tech companies, Apple and Meta and the big names, and look for ones that are showing signs of some good bullish entry points, so that we could get into those for longer swings and ride out a chunk of that tech rotation. Um, and so I was looking at the ideas around that, and one of the things that I came across, this was not my idea, but I kind of built around it. Um, I should have written down the guy's name. A guy by the name of Julius K. It starts with K. I can't remember. I couldn't pronounce it anyway. I would mess it up, but I'll find it for you and I'll post it later. But he came up with this idea of if you're looking for money moving within sectors, then perhaps the easiest way to do this and understand how that money is moving is to look at those sectors as a ratio comparison to the SPX itself. The sectors are based off of the S&P, the sectors within stocks that make up the S&P. And so um, if we use that and compare them to SPX, then perhaps we could see how that money is moving and understand it, take advantage of that. And so what he came up with was initially to do a ratio comparison of the ETF to SPX. Very simply, basically like, um, basically dividing the ETF value by the stock value and manipulating some math around it to work that out. And basically what you get is a number where 100 is SPX. If the resulting number for that rotation analysis goes above 100, that means that the price movement is outperforming SPX. If it goes under 100, then it's underperforming SPX. Then what he did was he said, now, if we take this a little bit further, and along with that, if we start measuring the momentum of that movement and do the same thing, where the normal movement momentum is at 100 for SPX, and if the calculated ratio momentum is above 100 for the ETF, then the momentum is outperforming the momentum of SPX, even though the price might not be. And if it goes under 100, then it's underperforming. And so when you put those together, I'm going to have to find an image of this very quickly. Um, this will do. So if you consider a quadrant like this, and so here in this, you can't really read it, but it says lagging under here. When we're in this lagging area, this means that the momentum of the ETF is underperforming SPX. And if we look over here, this other 100 vertical line here, this would be this side is the momentum, and then this is the actual ratio itself. So this would mean that, under this horizontal line, if it's under that, no, I got it backwards again. Okay, so if it's under the horizontal line, momentum is underperforming. If it's left of this vertical line, then the ratio is underperforming. And so those two things underperforming means that overall that ETF is lagging behind SPX. As the ratio stays under the SPX ratio, but the momentum goes above the momentum, then we get into this improving sector, meaning that it's not outperforming SPX yet, but it's getting better. It's catching up with it. From there, as that momentum builds, the ratio gets above the value for SPX. And so now both the ratio and the momentum are outperforming SPX. This is the leading area. And this is the area where we want to be in a stock, because it's outperforming the market basically, or that we want to be in that ETF, not necessarily a stock. And then eventually the momentum starts to die off for that particular ETF. It falls down, even though the price is still outperforming SPX. The price ratio is outperforming SPX. You get into this quadrant where you're weakening, even though it's still good. So the idea would be, as we get into here, we're getting into stuff. As we're weakening, we start getting out of stuff. So that's the concept that our friend Julius came up with. So I took that and I recreated something. Honestly, in TradeView, recreating this quadrant is very, very difficult. But I recreated something similar that we've got right here. And so what this is, let me just make all this just a little bit, actually, maybe I'll make that a little bit bigger. And I'll hide this temporarily. Okay. So what we have here on the right-hand side, each one of these labels is one of the sector ETFs for the S&P. So you've got we've got materials here, communications, energy, finance, industrials, tech, uh, consumer staples, real estate, utilities, healthcare, and consumer discretionary. Those are the 11 sectors. And each one of these colored rows, basically, it's telling you for the time frame that we're looking at, which of those quadrants this particular sector is currently in. And so we're also using big, long-term time frames for this. In this case, I've got the weekly because sector rotations they're not quick. They're not something that happens for a very short period of time. Big institutions, they don't get into something for a couple of months and then get out unless something really major happened that forced their hand. Normally, they're looking to hold these things for at least a couple of quarters. Usually, they're trying to hold for a few years at least. So we want to look at this big picture. Could this same thing work on a smaller time frame? Possibly. I have not done any sort of back testing at those levels. I can only go with, what I've learned at this point about what we already know and what I've learned through this rotation tool. So as an example, if we looked at, we'll just look at materials right here, where here's an area where through the period of November until looks like mid-February, materials were underperforming the overall market. I can even, sorry, let me do one thing to clean this up a little. We'll see if we can add a little more in here to help see. There we go. I'll put this back. And I'll actually put this on to XLB. So up here, the chart that we've got up here is showing the red line that's on here. That's actually SPX. And then the candles are XLB itself. And so you can see through this area, XLB was dropping. SPX wasn't particularly pushing very, very hard, almost more going sideways, but it certainly wasn't dropping like XLB was. Then we get into this blue area here where this is our improving area. And you can see that SPX is starting to drop some while XLB had popped up a little and was flattening out. And so it's improving. Even though it's not outperforming SPX yet, those numbers are getting closer. And then finally, we get into this area here in the third week of April, where things are turning around, things are moving up again, but the actual values are that XLB at this point is actually outperforming SPX. Because of the scales that are involved, you're not going to actually see that in the price movement. In this case, it looks like SPX is, because the line is above, it might make you think that that's the difference, but that's not what's going on. The percentage increases were stronger within the materials sector than it were for SPX, overall. So yeah, this is basically the tool that I put together to do this, and we're starting to test it now in the ACNI group, where we're looking for those indicators. And so what it actually does is these orange triangles that you're seeing, each one of those indicates a week where at least one sector turned to green, meaning leading. So if I look at, we've got this, well, let's use this one that's sitting out here in the open right here. And you can see if I come down here, right here on XLK, which is tech stocks, it had moved into there. Now it had pulled back out since there. There's obviously other things going on in the market that sort of caused that. If you look at the time frame, this was like February into March, so we know what was going on overall for the market during that period. Um, so in this case, we don't get that nice big long sector rotation, unlike we see with these other ones, where remember each one of these blocks is a week, so this is several weeks of activity like that. I'm just pointing out that this is showing that something started that week, so I can use this as an alert to tell me, hey, a sector rotated. It looks like a sector is rotating now. And that this will tell us which one it is. And in fact, if I put my mouse on here, the little tooltip that comes up will tell me exactly which one of the sectors this is. And if I go across a few of these, there's XLC on this particular one, healthcare, utilities, consumer staples, finance, and energy. All of those started rotating within that same time frame. So I have alerts set up for these. So every Friday, if we get a rotation, then in the ACNI group, in the ACNI chat, we'll actually get an alert that automatically comes into the chat to say, hey, just so you know, this is what's going on with this sector. So interesting stuff. And like I said, if you could take advantage of that, if we could take advantage of it and use these to take some longer term swings, kind of looking forward to getting into that this year, seeing how that all works out for us. And if you wanted to look for the actual name of the original indicator was relative rotation graph. And I'll get the guy's name, rotation graph. Julius de Kempeneer. I'm just going to paste it into the chat. There. And it was no, that's not it. Relative rotation graph. In case you want to look it up, get into it a little bit more. I'm sure there are some websites or potentially some other platforms that actually show it as the graph. And eventually I will get into that. I will get that done as well. But as something new that I've been researching recently, this is as far as I got so far. Yeah, so I thought you guys would find that interesting, and I figured I would throw that in there as well. So if you have questions about that, you can go ahead and throw those into the chat. And while you're doing that, I will go back up here, start looking over the tickers that you guys have thrown in. Start reviewing those. Just let me get my chart back to what I need it to be. Let's put this in there. We'll put that in there. We will put that in there. Good. I'm just using, if you're not familiar with some of these sessions, these are indicators that I've created that we use in ACNI. And since ACNI is it's the strategy that I use for all the trading that I do, I'm going to define everything based on some of the indicators that I use. But don't worry about the indicators so much. If you're not in ACNI, I'll talk about this stuff in terms of like the movement of the stock on itself. So it won't be telling you to look for levels or particular indications that you don't have, is basically what I'm saying. So let's start with the first one on the list, which is BABA. So first of all, I can tell you that overall, BABA's been down quite a bit since 2021, obviously. It's been making some recovery, obviously. Let me move down to the daily time frame and let's talk about what we're seeing. So it had previously gotten above some pretty big resistance levels in this purple zone that we're looking at here. Also, the orange zone is that upper zone is also some resistance that it got through. Just smaller time frame activity. That's all that represents. But generally, once we break out above those zones, I look for that zone to then become resistance and bounce off that. That didn't happen, which is not a great sign. It came back down, sort of bounced near the bottom of this other zone. This time it came back up after cutting through. It did come back up and it used that area uh, as resistance this time, rejected and started coming back down. So as it gets back down to this area, what I'd be looking for is on the bigger picture, the continuation of what it's got this little trend coming down here, but we haven't broken below this low back here. And what that means is that this is basically what I refer to as a complex wave set, where it's in a normal wave set, you would expect things to keep making higher highs and higher lows. When you get into an area where it's not making new highs or new lows, this becomes a complex wave set, and you wait for signs of things breaking out of that. So, what I would really be looking for to determine, at least for now, the direction it's going to go, I'd be looking at this top level up here. Oh, sorry. Let's try that again. Oh, actually, I misread that. It's actually breaking below that level already, making a lower low. So, as it's continuing the smaller trend to the downside, the next area is to watch this zone between basically 108 to 103. Watching that area to see if it's going to penetrate through there. Best case scenario, I would be looking for, if you're looking to go short on this, then the next area, because obviously this wave 7 coming down, this would have been the next opportunity to short it. Since that opportunity is already passed because it's going down, the next thing I'd be looking for is for it to break below that zone, come back up, retest somewhere in that zone as resistance, and then from there see if it continues to the downside. If you're looking for things to go to the upside, then all I'd be looking for is the opposite of that, where I would be looking for this to get down to this zone, hit it, let that zone or have that zone hold it as support and have it bounce off and start moving back up. And so to restart new bullish cycles on the daily, or if you're looking really long term on the weekly time frame, that's what I'd be looking for, is those new bullish cycles to go from there to continue to the upside. Again, I'd still be worried about whether or not it could get through this other zone, and it would need because we're in this downward trend. Obviously, the first thing I'd be worried about is that we don't break above this previous high. If the price gets above that previous high, then the next area I'd be looking at is, can it penetrate this zone and keep pushing up? Or is this overall just going to continue breaking down from there? But that's basically what I look for Bubba. Next on the list, we've got Intel. Intel is something that I currently have long term. Obviously, bought them at $21 a share. My big picture outlook for this. So, first of all, you can see that we got down and we were moving a lot of sideways through this area. We did have some bigger volatility earlier in the year. And I've been trying to patiently wait for it to push up. It is trending to the upside now. And ideally, the area that I'm looking for is for it to get up around the $40 area. I think originally I was talking more like 42, but put this back in. Must be a holiday thing. Okay, let's test this out really quick. Yeah, that's all it is. They do this for holidays sometimes. Okay, that was fun. Yeah, so I'm looking for bigger picture trend to continue, get this to break up sorry, wrong button. Break up above this orange zone and ultimately continue up, not all in one big move, but to continue up to that 38 area. For now, because it is starting to pull back, as it does this, I would like to see it come down, maybe around this area, bounce and start coming back up. I definitely don't want it to get below this lower area over here. Having it come down make a higher low compared to that and continue up would give me signs of continuation of this trend to the upside. Perhaps on a bigger time frame like this is the weekly time frame, and I want this. Um, I don't want this bullish wave on the weekly time frame that it's in to break down. I want it to continue up, and I want this to get a higher high than where it was. Actually, it might have actually done that already. But I want to see continuation where as these waves continue up, I want it to make higher highs and higher lows every time it does it so we can get back up here. I'm hoping that we'll get really good news in the ER report, but that's still a little ways away. They've been doing a lot of construction in Arizona, putting up new foundries and stuff there. And when you look at the different, when we talk about the chip companies and stuff, Intel is one of the actual manufacturers. So they are building foundries to do that. You've also got TSMC, who's also building in Arizona, and they're actually partnering with Intel on some of their stuff. So I'm hoping that all of that stuff will really bolster the earnings report. But you look at like NVIDIA and AMD, they don't make chips. Even though they are designing the world's leading chips in certain areas, they don't make any of them. They farm it all out to people like TSMC or companies like TSMC. But yeah, overall, big picture, I am looking at this to continue up, and so I'm watching for the current move down to make a higher low somewhere in this area. I mean, I could show you from a Fibonacci level point of view. I always look within the 382 to the 618 are my ideal zone for for a bounce to happen, for continuation of a trend. And so if that's the case, then I would expect somewhere in here it comes down and bounces and continues up. Looking over at Home Depot. So something a little bit similar as far as the way this is moving. It's been a little bit rough for Home Depot. We had this big low down here. We got up, made higher highs. And so the expectation initially for me was that this wave three coming up, I was looking for this to break above and continue above this previous high. Didn't happen. We got a little bit complicated and it broke down. So it's really trending a little bit to the downside. When it gets this kind of complicated, I tend to take a step up to a higher time frame and look at it from that point of view to see if I get a little more clarity. Um, we did get a good bounce off this zone. We're coming up, and so this high broke above the high from this previous one. So whether this just continues up, initially I'd be looking to this area up around 394 for it to get to. Whether it continues straight up there like that, or if it pulls back and bounces, I would be looking on a pullback for a higher low, just because it broke above this previous high for, something like this, and then start back up again to continue back up. Either way, with the goal of getting up for now up around that 394 area. When I said take a look at it from the weekly point of view, we get a little more clarity because it's not so choppy this way. Here's our low that we pushed up. We got this new wave 5 coming down. It did not make a lower low and converted to wave 3 on a bullish trend heading up. So these are signs of, I always tell the ACNI people about trend reversal signals. And this higher low is one of the signals that I look for as signs that our bearish trend is converting to a bullish trend now. And so, of course, the next thing I'd be expecting is that this is going to continue up, break above this high, which, as coincidence would have it, would put us right around that 394 target area that we're looking for. Hymns, which I had never heard of hymns. And then all of a sudden, everybody on the internet was talking about this like a couple of weeks ago, a few weeks ago. Yeah, it's obviously over the last year garnered a whole lot of new attention because it obviously blew up. Those type of stocks I'm always a little more cautious about because they're they're there's still a lot of volatility in it, and so we don't tend to get clean trends when there's high volatility like that. Still, looking at what we've got. So remember I talked about price getting over that purple zone, and then when it gets over it, I'm looking for it to now, if it breaks it as resistance, I'm looking at for it to be retested as support to see if the price will bounce off it. More recently, we did get a bounce there. Now, I don't like, obviously, some big news happened to get this monster gap down. Generally, that kind of thing comes from bad news. Um, and I don't really know what any of that was, but we appear to be bouncing in this area. We're starting to move up. I would be looking at starting new cycles on either if you're looking to go to the upside, I would be looking for new cycles to start on either the daily or the weekly time frame. We're not quite there yet on the daily. Basically, it would have to get over, if it gets above 49.20 roughly, that would be the start of a bullish cycle. And that's where I'd be looking to, on the day that happens, that's where I would generally be looking to get into a trade if I were looking at this one. But it appears that that's going to be the next move. Now, whether or not that pushes up, fills that gap, and continues up, I can't say. But it looks like, I mean, obviously there was no opportunity to get a short on this thing from where it was. And while it's running into this support area because it bounced off it, I wouldn't be initially looking to short it. However, if it does start that bullish cycle and comes up and only makes it up, say, as far as this upper zone, the orange one, doesn't make a new high and starts coming back down after rejecting it, then I'd be looking to short it here. You know what? I'll just use the arrows because they're cleaner. Yeah, so if it comes up to this area and then rejects and starts coming back down, then I'd look to short it from there to continue to the downside. Tesla, which is also on my list, but I have not purchased yet. And in fact, I was technically supposed to get into Tesla at about 284. That was where my signal came in. But at the time, there was just so much going on. Back in April, you know, things were just starting to kick up, and I was only willing to invest in so many of the stocks that were on my list at that point, and so this one just didn't make the cut. We are getting this pullback. We got up to that area and rejected. We've got this wave coming down. So with this bearish cycle that it's in, and so far it looks like on the weekly chart, it's trying to start one this week as well. Remember, tomorrow we've only got a half day and then the week's over. So if this doesn't pop up tonight or tomorrow morning, then we're going to start that bearish cycle. And so I'd be looking for continuation to the downside initially. There's no real opportunity to get into this. The move has already started without us, and I'm not a big fan of chasing. Maybe there'd be opportunities on smaller time frames to get something shorter term. We did have their sales numbers came out earlier this week, and they were less than expected, but surprisingly, the price went up on the stock. And I think that's because people thought it was going to be horrible. They thought the sales numbers were really going to be bad, and they weren't nearly as bad as they thought. So I can't really explain it other than that. However, those numbers, when it comes to the earnings report, may be much worse, but we got a lot of time before that earnings report comes out. So for now, I'd be looking for continuation to the downside and look for opportunities, you know, over the next month or two. I'd be looking for some opportunities to take it down. Although, like I said, really big picture, what I'm looking for is either this current move that it's in comes down, bounces somewhere above this low over here. So maybe it comes down to something like this level and bounces and comes back up and restarts a new bullish trend. Or if it's not going to if it's not going to make a higher low compared to this one, then I would look for continuation down as far as the 150 area and then start that bounce and recovery and start coming back up. Whichever one of those happens, that's where I'll be personally, I'll be buying shares for Tesla. Sorry, just let me grab a quick drink here. Where do we go on the list? Okay, Oracle is next. Um, wow, Oracle's really been moving lately. So Oracle basically made a new all-time high this week. Just let me see if there's something bigger in pre-market. Nope. Okay. So the way this thing is going, obviously it's been very, very bullish. It's it's in the middle of some big moves to the upside. So no real opportunity to get into it just yet. Because it's above those two zones that we talked about, the ideal setup that we would actually get for this would be that from here, it would pull back. Now, this would be a far pullback. So I don't, although I say it's ideal, this isn't the likely scenario. Ideally, it would be that we come back to one of those areas, bounce off, start a new move, and actually go higher. But like I said, that's probably a little bit too much. Let me see if we can put something else. So this, I'm looking at again some shorter time frame, same support and resistance levels looked at from a smaller time frame. So in this case, what I'd be looking at is that we do get some sort of pullback, and maybe it does only come back this far, down around that 214 level before it turns around and makes that next move up. But that's essentially what I'd be looking for on these, still on the big picture time frames, 4 hour daily kind of thing. I'd be looking for this to give some sort of pullback, a bounce, ideally off of some form of support like this. And then once we get that new bullish cycle within that time frame, then get into that trade to continue moving to the upside. There's not a scenario. It'll be a while before I could give you a scenario where I'd be looking to short Oracle after these moves. It would literally take the whole thing breaking down, getting back under these levels, then coming back up, retesting them as resistance and rejecting them like that before I would touch those. And that's literally something that would take probably a couple of months, if it even set up at all, which is not very likely. Yeah. Other than some huge catalyst that would make something happen, either geopolitically, economically, or within the company itself, I wouldn't anticipate wanting to short this anytime soon. For SoFi, so we're in that same sort of area where we broke above those zones. We're up above them now. So initially, what I would be looking for, well, what I would really like is for these to continue up a little higher so they separate themselves from all these boundaries here. So if it could go up just a little bit higher, then come back down and test this, bounce off of these levels, and then continue up, that would be the next trade that I would be looking for to the upside. If it's going to break down, then I just need it to do the opposite, where it would break under some of these levels, come back up to those levels and test those, and then reject and give us a short entry going this way. So depending on which way, or maybe you're looking at taking one or the other. Those are the two scenarios that I'd be looking for to get an entry for that. Of course, the one thing that I haven't talked about through any of those is perhaps people are asking what's going to happen based on they're already in a trade and they're holding. So I'd probably just take that same information and think about it from the exiting point of view that if that particular trade scenario works against you, then you should be taking your profit and getting out. Getting down here to okay, so we got NVIDIA next. NVIDIA's been getting very close to re-hitting their all-time highs, which a lot of people thought that the whole AI thing would die off and kind of go away. But I mean, that's not the way this stuff works at all. Uh, Pandora's box has been opened, and so we're going to keep pulling stuff out of it, partially out of curiosity and partially because sometimes we're too stupid for our own good. There are definitely some dark paths that AI could go down that we've got to be very careful of. But from a geopolitical point of view, there was all the talk about reduction of restrictions for AI chips going to a lot of new trade partners. Saudi Arabia and the UAE have talked a lot about starting to build a lot of their own AI farms. Um, and the White House said that they would look at easing some of those restrictions. There were some really big restrictions that were put on that they basically said we're pulling those off. And then they said, but we are going to replace them with something else. And I'm wondering if they're leaving a gap in between those two where some of these companies are going to be able to jump in and grab a bunch of extra stuff. Um, Either way, it's allowing this to come back up. There's a lot of new development stuff that NVIDIA has been doing. There are definitely some really cool scenarios with some of the stuff that they're doing. That there's a lot of implications for it that I don't even think people have really thought out a lot of the implications for stuff that they could do. I could give you, I can give you a really horrible, horrifying example. Um, there's a new processing chip and stuff that AI has created that's really, really small stuff. And it's going to allow for a lot more AI computation to be done on ultra small mobile devices. And originally they were talking about imagine having a video camera that sits someplace remotely that could do all the AI work itself of looking at footage that it's capturing and making decisions about what it is that it's actually seeing. Right now, that technology can be done, but it requires that the remote camera sends the video back someplace. It gets processed pretty fast. So it's still, if you're viewing it remotely, it still happens kind of real time. But none of that is happening at the camera level. And there are a lot of opportunities that could happen from that. And the horrifying one I can think of is right now, I don't know if you're aware of this, but okay, you are aware of this part. There are a lot of drones that are being using small drones that are being used in the Russian-Ukraine war right now. And one of the issues that they have always talked about is what happens with, like, why don't they just jam the signals so that they can't control these different drones that are literally being used in some cases to individually target soldiers, where the thing just flies up to them and C4 explodes and they're gone. Um, and so the what the Ukraine did, and other people are obviously doing this as well. They have come up with there. I'm just going to grab a picture of one. They are literally taking these tiny drones that have explosives on them, and underneath them they've got a 30-kilometer spool of fiber optic cable that look like this. And so they're using that, and they've got 30 kilometers that they can travel to find something and blow it up. And like this is basic stuff. These are all components. Matter of fact, these connectors, these are Hobby King connectors that they could buy. I could build this drone minus this spool and minus the expensive camera stuff they've got on it. I could build this thing for about $300. And so they don't need to worry about jamming signals because all of their video signals coming back to them to view and uh, all of the signals they have to put in to fly it, they're all going through that fiber optic cable. The problem is, obviously, now you're limited in the movement that you've got because of that fiber optic cable. If you get into a tight spot, then that fiber optic cable might get caught on something that causes an issue. They're leaving fiber optic cable all over the place. And maybe one of those, because eventually that fiber optic cable is just dragging across, well, it's rolling across the ground. So if you happen to fly past somebody, like one of the enemies, they could just get hold of that fiber optic cable and cut it really quick. They're easy to cut or break. Just bending it at a sharp angle will kill it. So lots of ways to combat that. Now, imagine if instead there's a microprocessing UA, a microprocessing AI processor on there that will that understands what its targets look like. And once it gets to the general area, even if it loses any sort of connection back to its main base, it knows its it knows its instructions, and it will just go out and search around until it finds a target and eliminates it. Or it might just say, okay, and if that can happen, just to make sure, uh, in absence of any target or something like that, fly up into the air and blow yourself up so that you're not recoverable parts for somebody else to use or anything like that. Anyway, the point is you could have the AI locally processing to do a lot of that stuff that normally takes uh, a warehouse full of computers to do that processing for you. So big opportunities for NVIDIA. That was a really long talk about NVIDIA. Sorry. Anyway, very much like some of those other things, we've broken above those zones. It's very bullish. So for now, while it's above, like this orange purple zone here, I am just looking for this to continue to the upside. So every time it drops down, starts bearish cycles, until it breaks back under these and starts breaking under previous lows, I'm just looking for an area where it's going to bounce, turn around, and start new cycles to the upside. And I'll continue doing that until either, like I said, it breaks down and gets below lower lows, or the next time it moves up, if it fails to make a higher high compared to the previous highs, then I would look not necessarily to short it, but I would stop buying up until I got stronger signals that it's going to start a new trend to the upside. Okay, next one is coin. Um, Coin's another one that's got a lot of stuff going for it right now. More and more, the government is talking about uh, allowing more stuff, especially around stable coins, loosening a lot of restrictions, really starting to treat a lot of cryptocurrency more as an asset, like a security asset. Um, probably, probably if they could stop calling it a cryptocurrency and call it something else instead, even if they just started calling them crypto assets, I think it would make things a lot more palatable, because the concept of referring to them as a currency is what really causes problems. I'm not going to go off on that a whole bunch, but um, the very basic concept that you come down to is that you can't you can't have something that's a currency but also a savings vehicle for like retirement growth or things like that. Um, so it's uh, it's complicated. Anyway, coin is benefiting from all of that because it's just getting more and more people interested in it. Even the Federal Reserve, Powell this week talked about building a requirement for some sort of stable coin, and they are in the middle of researching it. So um, certainly that could be coming. So same thing that I just talked about with NVIDIA. While it's above all of this stuff, anytime it starts to come down, I'm looking for opportunities to push it back up with every wave down until, like I said, we start breaking below lower lows, or if it comes down, bounces back up, fails to make a new high compared to the previous high, starts coming back down. At this point, I will stop trying to go long on coin, but I won't short it. This isn't a scenario where I would start shorting it right away. It's probably not something that I would want to start shorting it at all unless bigger problems started to emerge. It would just be more about taking a time out to let it come down before looking at like letting it give a smaller trend down before turning around and starting to trend back up again. And then we've got MSTR, which is very closely involved. become a little more neutral lately. Remember, I talked about those complex waves where you're not making higher highs, but you're also not making lower lows. Um, that's the scenario that it's in right now. So, really, what I would want to see from this is I want some stronger signals of which way this trend wants to move. And in this particular case, what I would probably need to see is with this current move that it's making up, I want to see it break above some of this stuff, come back down, retest it, and then continue this way. Or if it's not going to do that, then I kind of need it to do the opposite, where it comes further down this way and does something like this. Realistically, I don't see this bearish scenario as very likely. Probably looking more at this scenario here. We'll have to see because I know Bitcoin is getting very close to its all-time high. And so we'll have to see what it does in this area. If this rejects these levels, see it's running into those resistance zones. If it rejects here and starts coming down and starts pushing back down again, it's probably going to take MSTR with it. So we'll probably have to keep an eye on both of those. Uh, okay, so I think I covered those. I covered those. Mac had asked for Baba, but that was the first one that I did. And okay, so we've got Apple. Apple's another one that it hit my level to go long on it. So I bought shares at 201, 201.50 actually. So I've got shares of Apple that I'm in right now, and I am looking bigger picture, obviously looking for it to start trending back up. Longer term, I'm not quite sure about Apple. It like for a long time, Apple was all about the big tech stuff. They had the coolest computers, they had the best phones, they had all this new technology, and they were leading everything. Um, their computers are still good, but man, you pay an awful lot of money for them now. Their phones are still good, but they're not doing anything that everyone else's phone isn't doing. Um, they moved away from being the leaders in a lot of this technology, and they moved into um, focusing more on services. So for them now, it's more about the monthly reoccurring revenue than it is about being the leader in all this. So um, I don't know really big picture, like 5, 10 years from now, I don't really know where Apple's going to sit. They have tried looking into and getting into some of the newer technologies. You remember they got into cars. They were going to try to do electric vehicles. And then they kind of got out of that idea. More recently, while everyone else was doing it, they decided that they were going to start developing their own AI stuff. And they've come back, I think this week or late last week, they were saying they're reconsidering that and they may just end up partnering with a current AI company to to update Siri to full AI functions. So I don't know, but for now, I do like Apple. I've always liked it. It's still the heaviest weighted stock in the S&P. So I'm going to hold on to it. I'm looking for this to continue up. Um, so my next targets, if the market could keep pushing, getting up to that 230 area, eventually getting up to this 240 area, then we'll see if it can break through there. Once it starts getting up to new all-time highs, if that's where it gets to, then I'll feel much more comfortable about really long-term stuff. Um, I still have like for the next 5 years, I'd like to hold it. And if that's the case, even if it does pull back further, I'll just end up buying more later on as it starts to come back up again. But it bounced off this purple zone back here. And so I am looking for it to make the transition back up to the top of that, to the top zone now. And then we'll see where it goes from there. So Hunter was saying, thinking more about the new sector rotation indicator, would it be beneficial at all to compare the sectors to SPX EW, the equal weighted S&P? So if you're not familiar with that, the way the S&P works is that the top stocks beyond beyond just being like, some of the stocks that have the highest market caps, they are they are weighted heavier than other stocks, meaning that it's not just about the value of the shares themselves. They they comprise a bigger portion of the S&P. So if you went out and if you were buying individual stocks for to make up one giant S&P stock, and you bought one of every stock that was out there, then that would be more of an equal weighting where they each got their own value and there was one share of each. But in reality, Apple's weighted higher so that, it, well, everyone else, they were just buying one share, they bought like three shares of Apple. That's a very, very simplistic way of looking at it, but it's weighted heavier. Matter of fact, the top 10 stocks in the S&P 500, there's over 500 stocks in the S&P 500, and the top 10 stocks make up 35% of the total value of the S&P. So those top ones are weighted very heavy compared to most of the others. And so what he's talking about is there is another version. It's just a stock. It's not an actual fund, um, or it's not quite the way of putting it. It's not an index, but it basically just gives you the value of SPX, or there's one for SPY as well, that they just give you the values if they weren't weighted differently, if they were all equally weighted. And so off the top of my head, I don't know for certain, and I would have to really kind of think about what that would mean. But my first thought is that the the um, the default benchmark, one of the default benchmarks for looking at market growth is the S&P, including the weighting. And so when we talk about market growth and saying this is how fast the market is growing, um, that's what they're using as that measurement. If we use the equal weighted versions of it, then you might say, hey, based on the equal weighted version, I could buy this and I could be making, more money using this stock. But if in reality you could just buy the index and the actual index is outperforming, then it wouldn't really make sense. In a way, it's kind of like saying, well, what if I don't know, what if I just used Intel as the benchmark and compared against that? That's not the that's not the index that the whole market is measured against. So I'm like I said, I honestly don't know for sure, but that's my first thought is that um, yeah, it wouldn't be a good way to benchmark the performance of these things. But once I've got the indicator where I want it, and I'm going to have it available for the ACNI people. So maybe at that point, if you want to delve into it, because you can, like the way the indicator works, you can pretty much change whatever you want in it. So I can go in here and I could say, first of all, at the very top, I could say, here's what I want as the benchmark that we're using. So right now it's using SPX. I could use SPY. We could use, maybe we want to do it against the Dow Jones instead and measure it that way. You could change the index, the benchmark for whatever you want. And then, of course, the individual symbols, you could do it. So if I want to do this same thing to see how Apple is performing compared to the S&P, I could throw Apple as one of these tickers instead and do that individually. So yeah, it's definitely something you'll be able to test out at some point.